And so it's difficult because part of our educational process is helping people understand cash flow and how vital it is, right? You need to have, more money at the end of the month, quite frankly. If you don't have more money at the end of the month, you're going backwards, and nothing we can advise them to do is ever going to help.
Welcome. This is Dave Steinberg. Welcome to the Mortgages Made Easy podcast. I'm joined again by my friend John Thompson. John is one of the really most diligent guys I know in the mortgage business. He really works he really works hard at making sure that he serves clients very well and
Thank you. Yes.
uses innovative approaches.
Well, when you've been doing it for 35 years, you keep learning lessons over and over again. And I'm not a very quick learner, but I'm steadfast. I keep going and going and going, so it's okay.
As we're talking in mid-August of 2024, we've just seen the rates starting to ease up. God knows where they're going in the future, but starting to ease up from the very high rates we saw earlier in 2024, where we were seeing people get, let's say, FHA mortgages with a rate of 7+%, regular conventional mortgages over 7%. And we're seeing rates that are probably close to 1% or more below that right now.
Yeah.
Are you having conversations with clients or with their financial advisors about refinancing?
We are, and I think it's important to have those conversations now. And since we pinpointed the time, for those that are interested, there was a dip about 2 weeks ago in rates, kind of caught people off guard. It sort of became pretty evident that the Fed may become more aggressive and cut rates quicker. So the financial markets like that. And so the rates fell kind of unexpectedly. And they're like, okay, here's the beginning of it. We're going to continue to go down this slope and things will get better over the next several months. But then they immediately blip right back up, right? And it was a very short window of opportunity. And so I bring that up because we don't know where rates are going to go. We may get another window of opportunity, maybe 2 or 3. We don't really know. But the windows may be very small. And so being prepared in advance as a consumer, and if you have an interest rate that you feel you took during these last couple of years that's in the 7s, or maybe we did something in the low 8s, Dave, in certain circumstances, and products that are higher rates. And so being able to refinance those now into the 6s or maybe the high 5s, hopefully soon, could make complete financial sense. But if that window is only 5 days or 3 days or even 2 weeks, you need to be ready to go. So we are talking to the clients out of those rates, trying to come up with what we're calling a strike rate or a target rate, meaning that where is this meaningful for you? And so the question we're asking is, is there a dollar amount in terms of cash flow that would be meaningful to you? Is it $200? Is it $500? What is it that would make sense to you to go through the process of refinancing and trying to help them back into then what's the target or the strike rate to do? So yeah, we're doing those conversations right now.
I was just listening to someone talk about the Olympics and how much training and how much preparation goes into Olympics. We're not Olympic athletes by any means, but luck goes to those who are prepared, right? And so if you're listening to this podcast right now and you have a mortgage, let's say rate of 7.5% or 8%, as you said, or maybe it's even 6 3/4. The question you want to ask yourself is there a scenario that would warrant my refinancing? If not today, then in the coming months. And how do I prepare today for that event? So let's say if you have somebody with an FHA mortgage and their FHA mortgage is 6 months old, they're paying 7.25%. first thing you want to know about FHA mortgages is that there's a procedure to refinance FHA mortgages. You don't pay that full FHA fee all over again. And you can work this so that you have very minimal costs.
Yeah.
It's
Yeah.
still, because of the rate structure out there and because of the markets, there's some people who are dropping below 6%. That's a huge savings.
Yeah, absolutely. And there are streamlined programs. And so I would encourage you to think about, there are programs that are designed to be streamlined, VA, for example, FHA you mentioned, but even that, you can streamline your own process, right? So if you're a consumer who has a mortgage thinking about it, or you're an advisor who advises consumers, being prepared means, you know where your documents out there. You may not need all the same documents you did when you got your mortgage the first time. Maybe it's only one or two pay stubs. Maybe it's the most recent bank statement. Maybe you don't need bank statements. If you've worked with a lender before, which, we would always encourage clients to work with someone they know and trust already, they've worked with in the past, that person may have your driver's license and some information like that. But just as importantly is be ready to move quickly. If, like I said, we get a strike rate and let's say you said maybe it's 5.99 for someone and we hit that rate and it's next Thursday, right? And so the client has said, yes, that's the rate I want. Please get it committed for me. If Dave then gets it locked in, you have a time frame to get it done within. You have to deliver that lock typically within 30 days, depending on the situation. And so the client needs to be ready to move quickly, right? Be responsive. And when Dave calls you and says, we're doing it, we're locked, you got to go. Right? So,
the other thing that I've been running into, I'm sure you have clients like this as well, is there are lots and lots of people, probably 60% or more of the people who have mortgages right now have mortgages with a rate of 3.5% or better.
yeah, yeah.
And so many people start with the premise that if they have a 3.5% rate, they shouldn't refinance. Is that true? Is that a good idea, John?
I think you always start with an analysis, right? So I think you're absolutely right. People feel like they call it the lock-in effect, right? So yeah, I have this low rate, it's 3.5 or below, and so have no need to talk to anyone about refinancing. But a couple of things. So the obvious things are sometimes people have incurred additional debt. We've had a lot of clients who've taken on home equity lines of credit for the same reason. They didn't want to refinance that 3.5 rate or 2.875, so they got a line of credit, which might be at 9 or 10 or 11. And so that money is costing more money. Maybe they've taken on some credit card debt, or they've looked at other situations. Maybe they got a car loan, student loan. So there's that obvious reason to look at the overall cost of a household debt, and then determine, okay, so now what's my real strike rate? If my blended cost of debt is 5.7, then now I have a target rate. So that's the obvious one. But what's maybe not so obvious? Well, you shared a story with me about a client of yours that was looking to purchase an investment property. They had some other debt and some things like that. So even though they had a low interest rate, they were able to pull cash out, right? They took a higher interest rate. They've now deployed that equity into other more productive assets and improved their cash flow at the same time. So that's why you look at those things, because you never know what someone's situation is. And I always would start the conversation with what's taken place in the last 12, 18, 24, 36 months. What's different in your life? Maybe suddenly you're anticipating having a baby, or a kid's going to college, or, all sorts of different things happen. So yeah, I think there is a reason. If nothing's happened and they're staying in the home the rest of their life, maybe they don't refinance at 2.875 rate, but at least talk about it.
Yeah. We have a client who just, as you said, refinanced his home, and he was buying an investment property. And we calculated that by taking 50% of the money on his primary residence and 50% of the money on his investment property, he actually saved money relative to not touching his primary residence and taking the entire mortgage on his investment property. It took a little bit of adjusting because this guy was very happy not having a mortgage on his primary, but you really have to understand the whole picture. And we're getting that also with some of our older clients, people who are gearing towards retirement, and now they're looking to buy the second home. In my world, they're looking to buy a home in Florida and Delaware and
Yeah.
the Carolinas, and they may have enough for a nice down payment, but when you look at the blend, what's your total cost of home ownership? What's your total cash outgo?
Yeah.
Are you better off keeping your current home unencumbered, or maybe you take part of the money out of your current home, part of the money out of new home, some of it out of your savings, and use that way to pay. And when you look at the cash flow, sometimes the advantages are very dramatic.
Yeah, that's very creative. At the end of the day, I think we feel the same way, that we're debt agnostic, right? It's really about, cash flow and payments and sort of the overall cost of money, because things are very fluid. At the end of the day, we look what's happened to our world in the last 5 or 7 years, what's going to happen in the next 5 or 7 years, right? And interest rates are certainly going to go through a cycle or two over the next decade or two. So even if rates are high now, they're going to come down and vice versa. So it's always a fluid movement when you're analyzing the debt and cash flow. There's very few one-time decisions, at least in my opinion,
Yeah.
about this kind of stuff. So,
And like our mutual friend Todd says, people lead a life of cash flow.
yeah.
And so, what does that mean to you?
Well, personally, what does it mean to me? I have a lot of overhead. So I want cash flow to be better so that I get to keep some of my own personal cash flow for my business. But I know that's not what you're asking, Dave. What you're asking is, for most people, right? Money comes in at the beginning of the month, right? They got some bills and expenses, and some are committed and some are voluntary. And they're hoping at the end of the month to have a little bit left over. And then they make a decision, what do we do with this money when it's left over? Is it retirement money? Is it, play money? Is it so forth? And of course, we encourage productive use of money. It goes to sort of building wealth over time and doing other good things with money. But that's all it is. But I'll go backwards and say the challenge, I think, for most people is they don't really know what they begin the month at or what they end the month at, right? I mean, how many clients do we both have that have no clue? They don't even, half times they don't know what they even make. Right? So they can't know what they're spending. And so it's difficult because part of our educational process is helping people understand cash flow and how vital it is, right? You need to have, more money at the end of the month, quite frankly. If you don't have more money at the end of the month, you're going backwards, and nothing we can advise them to do is ever going to help at the bottom line. So,
Yeah. Hey, John, this has been a lot of fun. Thanks a
yeah,
lot.
thank you.
And this is the Mortgages Made Easy podcast with Dave Steinberg, my guest, John Thompson from SMPL Mortgage in California. And if you have any questions about anything we've raised, my information will be below, John's information will be below. Feel free to reach out to us. Thanks so much, and coming back at you.
Thank you. I appreciate you, Dave. Have a good one.